Imagine a big fish, let's call it Megacorp, with a serious appetite. It spots a smaller, tastier fish named TinyCo swimming nearby. Gulp. Megacorp swallows TinyCo whole. That, my friends, is like a corporate acquisition. But what happens to TinyCo's financial records? They change. That's where Pushdown Accounting comes in. Pushdown Accounting is like giving TinyCo a financial makeover. Megacorp's accounting rules now apply to TinyCo. TinyCo's assets and liabilities are reevaluated based on what Megacorp paid. So, next time you hear about a big company gobbling up a smaller one, remember the fish in the makeover. That's Pushdown Accounting in a nutshell, an essential part of the corporate world. Now let's dive into the nitty-gritty of this financial makeover. One of the key aspects of Pushdown Accounting is the step-up. This is the process of adjusting TinyCo's assets and liabilities to their fair value at the acquisition date. Imagine Megacorp paid a premium for TinyCo, seeing hidden potential, or maybe just a really cool office space. This premium gets reflected in the step-up, so TinyCo's assets, like that rusty stapler, might get a value boost. Liabilities, on the other hand, might also increase if Megacorp assumes TinyCo's debts. It's like a seesaw, trying to balance the books. The difference between the purchase price and the fair value of TinyCo's net assets is recorded as goodwill. Think of it as the feel-good factor of the acquisition, the intangible value that Megacorp sees in TinyCo. This goodwill, however, can be a tricky beast, as we'll explore later. For now, just remember the step-up. It's like a magic wand that transforms TinyCo's balance sheet, reflecting the new reality of being part of Megacorp's empire. It's the accounting equivalent of a glow-up. Pushdown accounting isn't mandatory. It's like an optional accessory, a fancy hat that TinyCo can choose to wear. So when does it make sense to put on this hat? Well, several scenarios might make Pushdown accounting a good fit. One common situation is when TinyCo is about to be spun off or sold again. Presenting its financials using Megacorp's basis can make the sale process smoother. It's like dressing TinyCo up for a potential buyer, making it look more attractive. Another scenario is when TinyCo has to comply with certain regulations or debt covenants. Pushdown accounting can help TinyCo meet these requirements, keeping the financial police happy. It's like giving TinyCo a financial ID card that proves it's part of the Megacorp family. However, Pushdown accounting can also be a headache. It requires a lot of paperwork and can create complexities in tax reporting. It's like organizing a very elaborate party, fun in theory, but a logistical nightmare in practice. So, the decision to use Pushdown accounting is a balancing act, weighing the benefits against the costs. It's like choosing between a comfortable pair of slippers and a pair of stylish but painful high heels. Section 4. Goodwill Hunting. Navigating the intricacies of goodwill and impairment. Remember that feel-good factor we talked about, the goodwill? Well, it's not all sunshine and rainbows. Goodwill represents the future economic benefits from acquiring TinyCo. But what if TinyCo doesn't live up to the hype? That's when goodwill impairment comes into play. Public companies test for goodwill impairment regularly. Private companies have more flexibility. They can amortize goodwill over 10 years or less. Goodwill can boost TinyCo's balance sheet, but also cause headaches if things go south. Section 5. Showing your work disclosures and presentation in Pushdown Accounting. If TinyCo decides to embrace Pushdown Accounting, it can't just magically change its financials without explanation. It needs to show its work, like a student meticulously documenting their calculations. This is where disclosures come in. Disclosures are like footnotes explaining the ins and outs of the pushdown process. They provide details about the acquisition, the fair value adjustments, and the impact on TinyCo's financial statements. Think of it as a detailed recipe, outlining all the ingredients and steps involved in the financial makeover. The presentation of TinyCo's financials also changes. Pre- and post-acquisition periods are clearly separated, often with a vertical line. It's like drawing a line in the sand, marking the before and after of Megacorp's takeover. This helps users of the financial statements understand the impact of the pushdown. So, transparency is key. Pushdown accounting requires clear and comprehensive disclosures, ensuring that everyone understands the changes and their implications. It's like giving a behind-the-scenes tour of the financial makeover process. Section 6. Pushdown Accounting in the Wild Real-World Examples and Their Quirks. Pushdown accounting isn't just a theoretical concept, it's happening in the real world, with real companies and real consequences. Imagine a tech giant acquiring a trendy startup. The startup's main asset might be its innovative software. This can lead to discussions about fair value and goodwill. Is it the next big thing or just a flash in the pan? It's like trying to put a price tag on creativity. These examples highlight the complexities of pushdown accounting in practice. It's not a one-size-fits-all solution. and each case requires careful consideration. Section 7. Wrapping it up. A humorous recap of Pushdown Accounting. So there you have it. A whirlwind tour of the wonderful world of Pushdown Accounting. We've explored the fish analogy, the magic of step-ups, the Goodwill hunt, and the importance of disclosures. It's been a journey, hasn't it? Pushdown Accounting is like a financial makeover, transforming the acquired company's financials to reflect the acquirer's perspective. It's a complex process, but it can be beneficial in certain situations like spin-offs or regulatory compliance. It's like giving the acquired company a new wardrobe and a new identity, but it's not without its challenges. Goodwill impairment can be a headache, and the disclosures can be overwhelming. It's like navigating a maze of accounting rules and regulations. But hey, at least it's never boring. So the next time you hear about a corporate acquisition, remember the fish and the makeover. And if you ever find yourself knee-deep in pushdown accounting, remember to breathe, take it one step at a time, and don't be afraid to ask for help. After all, even accountants need a lifeline sometimes.